Hello and Assalamualaikum. Today our group will be presenting the annual report for SIME and IOI Corporation. Today I will be presenting the historical background of SIME. SIME was founded in October 1910 by two individuals, which is William Syme and Henry Darby. Their initial focus was on the rubber industry, which was booming at that time. Over time, they diversified into palm oil and cocoa cultivation, laying the foundation for their future success. So in 1977, the company was acquired by Malaysian investor primarily through Straitwine Sdn Bhd. And in 2007, a landmark merger took place. Sime Darby merged with two other companies, which is Guthrie and Golden Hope, to form Synergy Drive, which was later renamed back to Sime Darby Bhd. In 2017, the company went through a major restructuring, splitting into three separate entities, which is Sime Darby Plantation Bhd, Sime Darby Property Bhd, and lastly Sime Darby Bhd. Last year, in May 2024, Sime Darby Plantation Bhd was rebranded to SD Guthrie Bhd. On 15 November 2024, Sime Darby Bhd announced it, marking a shift in focus towards becoming a pure play powerhouse in automotive and industrial equipment sectors. Next, I will be presenting the incorporation and evolution of IOI Corporation Bhd. IOI Corporation was founded on 31st October 1969 under the name Industrial Oxygen Incorporated Sdn Bhd. The company achieved a significant milestone when it was publicly listed on the Kuala Lumpur Stock Exchange, now we call it Bursa Malaysia, in 1980 under the stock code MYX 1961. In 1983, the company entered the oil palm plantation sector, which is now a core part of its business. In 1984, it expanded into property development, adding another revenue stream. By 1997, IOI ventured into oil refining, strengthening its position in the palm oil value chain. The company was founded by Tan Sri Lee Shin Cheng, who served as executive chairman until his passing in 2019. He was a visionary leader who drove the company's expansion into plantation and manufacturing. Today, the company is led by Lee Yew Chor, the current CEO, who continues to steer IOI's global growth. Let's explore their key business segment.
Right, so now
Plantation.
I will
IOI has operations in Malaysia and Indonesia.
for both companies.
Resource-based manufacturing. IOI operates two palm oil refineries in Malaysia. In addition to its core business, IOI is also driving innovation in sustainable products. To sum up, IOI Corporation has grown from a local company into a global powerhouse through diversification, strong leadership, and sustainability initiatives. With its global market reach and innovative products, IOI continues to strengthen its position as a leading player in the plantation and manufacturing sectors.
And further dropped to 1.8 in 2023. This indicates a decline in the company's ability to meet short-term obligations using current assets. In the quick ratio, it showed a moderate level in 2021 at 0.78 but decreased to 0.69 in 2022 and slightly increased to 0.70 in 2023. Although there was a slight improvement in 2023, the ratio means below 1.0. Right, now for IOI Corporation, reliance on 2021, IOI Corporation exhibit a strong current ratio. Overall, the decline in both ratios suggests solid ability to cover short-term challenges in maintaining current assets, with a significant dependence on inventory over the past 3 years, and further to 2.94 in 2023, suggesting a gradual decrease in the company's liquidity position. However, all value remain well above 1.0, which still points to a comfortable ability to meet short-term liabilities using current assets. The quick ratio also showed a stable performance. It was 2.31 in 2001, followed by a slight increase to 2.35 in 2022. In 2023, it slightly dropped to 2.25. Despite the minor decrease, the quick ratio remains strong, further indicating that IOI Corporation can meet its short-term obligation without relying heavily on inventory. Overall, while there has been slight decline in both the current and quick ratio over the past 3 years, IOI Corporation's liquidity position remains healthy. The company continues to demonstrate a robust ability to cover short-term liabilities, with minimal dependence on inventory. The trend suggests a manageable decrease in liquidity, but it does not indicate immediate liquidity concerns. 2.2 Asset Management Ratio, Inventory Turnover. The inventory turnover ratio of Standard Berhad has been on a gradual downward trend for the last 3 years. In 2021, the company was at a robust inventory turnover ratio of 4.80, indicating good inventory management and strong sales. This ratio marked a decline to 4.01 in 2022, reflecting a slight slowdown in inventory turnover, which can be attributed to either faltering sales or less effective management of inventory. In 2023, that ratio plummeted yet again to 3.80, the lowest across the 3-year period. This decline may indicate various challenges, such as a decrease in demand, overstocking, and inefficiencies in inventory management. IOI Corporation improved and maintained a good trend in its inventory turnover ratio for the third consecutive year, firmly establishing itself a value of 6.91 in 2021, indicating reasonable effectiveness in managing its inventory. Following an upward slight change, the overall turnover in the same ratio increased to 7.07 in 2022, reflecting very good performances in inventory management and sales. A notable increase is shown with 8.37 in 2023, which reflects further improvement in inventory management, and this can possibly be attributed to some recovery in sales or better supply chain handling. Standard Berhad's day sales outstanding has seen a steady increase in the past 3 years. In 2021, the DSO was 22.6 days, which means this is the amount of time it took on average to collect a company's receivables. Hence, it shows an excellent manner of cash management. By 2022, though the collected days rise to 26.3 days, which reflects a slowdown in the collection of cash from that year, or the fact that their clients somewhat took more time on payment. The shift continued in 2023 with the DSO bleeding to 28.5 days, indicating that it took longer to collect the receivables. For IOI corporations, their DSO for the past 3 years has exhibited radical variability. The DSO was relatively high in 2021 at 35 days, meaning the company took longer than usual to collect its receivables. This marked a massive improvement in performance for the year 2022 at 27.3 days, implying better management of cash flows and a more efficient collection process. In 2023, the DSO climbed marginally to 29 days, possibly reflecting a very slight slowdown in the collection of receivables or a minor change in customer payment behavior. Standard Berhad's fixed assets turnover ratio has fluctuated within a range over the past 3 years. For 2021, it registered at 3.54, meaning a quite sizable amount of revenue relative to the dollar invested in fixed assets. This was further improved to 3.63 in 2022, a very good performance in terms of sales generated from fixed assets. In 2023, though the ratio decreased to 3.13, slight efficiency drop or slow growth in revenue, proving the diminishing power of the fixed assets base.
Right now, I will
For
explain
IOI
about debt management
the turnover ratio
For
of
debt
fixed
ratio,
assets
the formula
tells
is
us about
total
highly
liabilities
pronounced
divided
variations
total
in the last
assets.
3 years.
Now I will
In the year
explain for some
2021,
company.
the ratio
Over the
had
3
been at
years
a
from
lowly
2021
0.91,
to
signaling that the company
2023,
had made
Sam Darby's
less
debt ratio
revenue for
steadily
every dollar
increased
put in
from
fixed assets.
32.3%
However,
in
in
2021
2022,
to
a further improvement was
37.8% in
experienced with a sudden
2023.
escalation of
This trend reflects
1.24,
a growing
indicating the
reliance on
company
debt
was
to
using
finance
these
its
fixed
assets,
assets much more
signaling a higher
efficiently
level of financial
to
leverage
generate
and
this
potential
revenue.
decrease.
The ratios may
Although the
have
company's
improved due
debt
to better
ratio
asset
remains manageable,
utilization or an
the
increase
increase
in sales.
suggests a shift
In
towards more
2023,
debt
the company's
financing,
measure dropped
which
back
could
to
impact
a
its
repeated
financial
level of
stability if not
0.91
matched
that
by
was seen in
sufficient income growth.
2021, something
For
indicating
IOI
a slowing
Corporation,
growth in
from
revenues or
2021 to
inefficient use of
2023,
fixed
IOI
assets.
Corporation debt ratio has shown
Standard
an
Berhad's
increasing trend
total
rising
asset
from
turnover
49.3%
is
in
in decline over the
2021
past 3
to
years. In
72.1% in
2021, the ratio
2023.
was
This indicates that the
1.56,
company's reliance on debt to
indicating that the
finance its
company
assets
was
has grown
generating a
over the past
reasonable
3
amount
years.
of
The increasing
revenue
ratio
for
suggests
every
higher
dollar
financial
invested
leverage,
in total
which may
assets.
raise concern regarding the
However,
company's
in
ability to manage
2022,
its
the ratio
liabilities to
was
pay as
down
much
to
as especially
1.40,
during times of
thus
economic
suggesting that
uncertainty.
the
In
efficiency of
2022,
using their
they need to
total
pay as
asset
much
was
as
slightly on the
12.44
decline,
cents for each tax
meaning
input.
it was
And in
likely that the company
2023,
was not
operating companies
utilizing
need to
its
pay as
asset to
much
the
as
same
6 ringgit
efficiency
43
levels
cents
compared
for
to the
each tax
previous year.
imposed.
It
Debt interest
continued
ratio
to
in
decline further
2021
to
is the highest and decreased
2023
in
and registering
2022 and also
1.30. This
2023.
likewise
For
implies
IOI
a
Corporation,
noticeable
in
decline in asset
2021, operating
utilization.
companies are required to pay as much
IOI
as 20 ringgit
Corporation's total
21
asset
cent
turnover
for each
ratio
tax imposed.
has
In
fluctuated over the
2022,
past
they
3
need to
years.
pay as much as
The
18
company's
ringgit
asset
68
turnover
cent
ratio
for
was
each
at
tax
a low
imposed.
level of
And
only
for
0.63 in
2023, they need to pay
2021,
as much as
showing some
21 ringgit
inefficiency
26
in
cent for
revenue
each tax
generation
imposed.
from its
Time interest
assets.
ratio in
However,
2021
the
is the
ratio
second highest
improved to
and decreased in
0.81 in
2022 and goes
2022,
highest back in
indicating better asset
2023.
utilization
Next,
and
I will move to
increased
the next
revenue
presenter.
generation. This increase can occur either due to efficiencies built over that period or sales growth.
In 2023, the ratio fell again to 0.65, slipping back to levels similar to those recorded in 2021, which could indicate slower revenue growth or less effective management of assets.
So for the profitability ratio, for the Sun company part, we started with the operating margin. So as we know, the operating income formula is the EBIT divided sales. As we see in 2021, the profitability ratio was 5%, which is showing stronger operational efficiency compared to the following years in 2022 and 2023. The ratio dropped to 4%, suggesting a slight decline in profitability relative to revenue. While for the IOI corporation, the operating margin show the highest ratio was in 2021, which is 70%. Profitability dipped significantly in 2022, was 11%, despite higher sales in 2023, which was 16%. This shows a recovery in profitability compared to the previous year, even with lower sales than 2022. Is profit margin. Profit margin formula is net income divided by sales. As we see from the Sun company in 2021, the profit margin was 3%. This indicates that the company earned 3 cents of profit for every 1 ringgit of revenue. In 2022, the profit margin dropped to 2%, showing a decline in profitability compared to the previous year. In 2023, the profit margin returned to 3%, maintaining the same level of profitability as in 2021. While for the IOI corporation, shown in 2021, had the highest profit margin at 12%. This indicates stronger profitability relative to sales. In 2022, despite higher net income and sales, the profit margin slightly declined to 11%. In 2023, saw a further decline in the profit margin to 10%. This reflecting reduced profitability compared to sales. For the return on asset, ROA, the formula is net income divided total assets. As we see, for the Sun company in 2021, the ROA was 5%, meaning the company generate a profit of 5 cents for every 1 ringgit of assets. In 2022 and 2023, the ROA decreased to 4%, indicating a slight decline in the company's ability to generate profit from its asset. While for IOI Corporation in 2022 had the highest ROA at 9%. This indicates better efficiency in utilizing assets to generate profit. In 2021, had a slightly lower ROA of 8%, reflecting comparable asset utilization, although 2023 saw a notable decline in ROA to 6%, indicating reduced efficiency in converting assets into net income. Now, for the return on common equity ROE, the formula is net income divided common equity. For the same company, in 2021, the ROE was 5%, showing a stronger return for shareholders based on their equity investment. In 2022, the ROE declined to 12%, indicating reduced profitability relative to shareholder equity. In 2023, ROE improved to 16%, reflecting a rebound in profitability and effective utilization of equity. For the IOI Corporation, in 2022 recorded the highest ROE at 15%, showcasing the company's ability to generate a higher return on the shareholders' equity. 2021 followed with ROE of 13%. This indicate stable performance. 2023 saw a significant drop to 10%, reflecting reduced profitability relative to shareholders' equity. Now for the return on invested capital, ROIC, the formula is EBIT times 1 minus tax divided total invested capital or total assets. So for the same company, in 2021, the ROIC was 16%, indicating the company generate 6 cents for every 1 ringgit of invested capital after accounting for taxes. In 2022, ROIC dropped to 4%, showing decreased efficiency in using invested capital to generate returns. In 2023, ROIC remained stable at 4% despite increased total invested capital. While for IOI Corporation, in 2021 was 9%, showing that IOI Corporation generate 9 cents for every 1 ringgit of invested capital after taxes. 2022 ROIC declined to 7%, reflecting decreased efficiency in using invested capital. In 2023, ROIC rebound slightly to 8%, indicating a partial recovery in efficiency despite higher taxes and fluctuating invested capital. Last but not least, basic earning power, BEP. The formula is EBIT divided total assets. So for the same company in 2021, the BEP was 8%, meaning the company generate 8 cents of EBIT for every 1 ringgit of assets. These indicate strong operational efficiency. Apart from that, in 2022 and 2023, the BEP dropped to 6%, reflecting slightly lower efficiency in using total assets to generate operating income. While for the IOI Corporation in 2021, the BEP was 11%, indicating the company generate 11 cents of EBIT for every 1 ringgit of assets. In 2022, BEP dropped to 9%, reflecting reduced asset efficiency. In 2023, the BEP improved slightly to 10%, showing a recovery in the company's ability to generate earnings from its assets. That's all from profitability ratio.
Today, I will be presenting the DuPont analysis for same company and IOI Corporation for 2021-2023. The DuPont analysis is a financial framework used to break down return on equity or ROE into a 3 component, which is a profit margin, asset turnover, and equity market value. This helps us understand what drives a company's financial performance and identify areas for improvement. For some company, we observed a relatively stable ROE performance throughout the 3 years. In 2021, the ROE was 15.32%, supported by a strong profit margin and significant leverage, as seen in the high equity multipliers. However, in 2022, the ROE dropped to 11.84% due to a decreased asset efficiency and profit margins.
Other than that, Sun Company rebound in 2023 with an ROE of 15.63%, thanks to improved profit margin and increase in leverage. This shows that some companies consistently use a leverage to maintain stable returns even during challenge periods. For IOI Corporation, the ROE trend was a difference. In 2021, the company achieved a 13.52% ROE, driven by a healthy balance of assets efficiency and profit margins. By 2022, the ROE increased slightly to 50.29%, reflecting better asset utilization and profitability. However, in 2023, the ROE declined sharply to 9.55% due to reduced profit margin and significant decrease in leverage. This indicated that IOI Corporation faced difficulties in maintaining profitability and efficiently utilizing its assets during that year. In conclusion, the DuPont analysis highlight how above companies performed financially over these 3 years. Sun Company relies heavily on leverage to sustain its ROE, while IOI Corporation faced a challenge in profitability and assets management, particularly in 2033. This insight can guide above company in improving their financial strategy moving forwards. For this slide is about conclusions. Based on the analysis conducted, IOI Corporation demonstrated a stronger financial performance compared to Sam Darby. IOI Corporation higher profitability, better liquidity and a solid market valuation provide a competitive advantage. However, the companies need to reduce in reliance on debt financings and improve asset utilizations, particularly fixed assets to enhance revenue generation effectively. On the other hand, Sundarbi asset utilization as evidenced by its higher fees and total asset turnover ratios. However, the company faced a significant challenge due to its reliance on inventory and declining cash levels, which hindered its ability to meet short-term commitments. Since Sundarbi must focus on optimizing inventory management and investing in modern technologies to enhance operational efficiency and cost management. For my opinions, both companies are encouraged to implement initiatives such as the first one is investing in innovation and technology to remain competitive. The second one is monitoring market trend closely to adapt strategy for long-term growth. The next one is a building strategy partnership to expand market reach. And the last one is strengthening corporate governance to improve transparency and investor trust. By addressing these areas, both IOI Corporation and Sam Darby can strengthen their financial to recover quickly, operational efficiencies and cooperative positionings and ensure stable growth in the long run. So that's all for us. Thank you.